You're looking at a market flashing a fear gauge of 15 out of 100 today, which, usually signals a full-blown stampede for the exits.
Right. Total panic.
Yeah. But if you peel back the data from June 19th, 2026, well, that panic narrative just doesn't actually hold up. Welcome to today's deep dive.
We are tearing into a massive macro liquidity squeeze, looking at forced liquidations and tracking some pretty hidden infrastructure pivots today.
Because while the surface metrics scream extreme fear, corporate treasuries are quietly scooping up billions. So let's figure out why.
Yeah, the key to that disconnect really lies in the market plumbing. I mean, the systematic pressure that forced Bitcoin down to a $62,567 close lows wasn't a sudden crisis of faith.
Right? It was something else entirely.
Exactly. It was a result of an $8.3 trillion traditional options expiration.
Wow. And because of the Juneteenth holiday, that entire expiration just got jammed into Thursday.
Yeah, compressed into a single day.
But wait, if this is a traditional equity options event, why is it crashing Bitcoin? I mean, how does balancing equity books bleed over into digital assets?
Well, when institutional market makers have an expiration of that massive size compressed into a shorter window, they have to frantically rebalance to stay market neutral.
Right, to cover those core equity positions.
Yeah, and to raise cash fast. So their algorithms automatically sell off highly liquid peripheral risk assets. The crypto market effectively becomes like an ATM for traditional finance.
An ATM. Okay, yeah, that makes sense for broad spot prices. But what about Strategy Inc.? Because their digital credit preferred stock, STRC, that just cratered to a record low of $88.59.
Yeah, that was a pretty brutal drop.
It was. So if this is just automated rebalancing, why did a specific income-generating asset crash that hard? Before we answer that, what even is STRC paper in plain English?
So STRC is essentially corporate debt issued by Strategy Inc.
Yeah.
That pays a dividend. And it is highly attractive to retail investors who hold, I think it's about $8.8 billion of it.
Mm.
But here is the critical part. Those investors frequently borrow against that paper to buy more and enhance their yield.
Ah, I see. They're buying it on margin.
Exactly.
So when the broader market took a hit from that options expiration, their collateral value dropped.
Resulting in massive margin calls. They were basically forced to sell STRC just to cover their loans.
So it's a classic leverage liquidation.
Yeah, very similar to historical legacy hedge fund failures. Matt Cole actually compared it to the forced selling involving highly leveraged U.S. Treasury positions.
Right.
The selling becomes completely disconnected from the underlying strength of the asset. I mean, Strategy Inc., dividend reserves, and actual creditworthiness are perfectly fine. We simply watched a painful washout of structural excess.
Wow. And while retail is forced into those liquidations, institutional capital is doing the exact opposite. Because their algorithmic models operate 24/7, they exploit these temporary localized discounts while, human traders are reacting to margin calls.
Right. They just sweep in and buy the dip.
Yeah.
Strategy Inc. actually acquired another 2,587 Bitcoin during all of this.
The institutional entrenchment is staggering right now. Take BlackRock's IBIT ETF. It just crossed an estimated $187.2 million in annual fee revenue, which officially passes the revenue of BlackRock's flagship S&P 500 ETF.
Yeah, beating the S&P 500 ETF is a massive shift.
It's huge, but massive institutional capital requires serious protection against the exact kind of volatility we just saw in the retail market. You can't have billions in a corporate treasury at the mercy of purely digital whims.
Which is exactly why the infrastructure layer itself is decoupling from spot price reliance. Top-tier providers are building physical hedges to protect that capital. Bitdeer is a perfect example. They mined 921 Bitcoin this past month, but they are simultaneously dismantling mining centers in Washington state to install NVIDIA GPU clusters.
So instead of acting like a simple extraction facility, they operate more like a train switchyard.
That's a great way to look at it.
They have this massive influx of power, and they can dynamically switch the tracks, sending that energy to hash Bitcoin or routing it to power AI collocation.
Whichever cargo pays the highest freight that day.
Exactly.
That is the pivot. By doing that, Bitdeer is already generating a $69 million AI computing revenue run rate. They are monetizing their power capacity regardless of whether the digital asset market is euphoric or terrified.
So the extreme fear metrics and the surface level price drops are essentially just a smokescreen.
Pretty much, yeah.
To really understand what's actually happening, you have to separate the noise of localized leverage flushouts from the signal of massive long-term infrastructure deployments.
Because if you only look at the spot price, you completely miss the structural entrenchment happening beneath it.
Which brings us to something to chew on after you finish this deep dive. If traditional options expirations are now directly triggering digital credit liquidations, how long until legacy financial plumbing and digital asset infrastructure become completely indistinguishable?
It's a great question to end on.
We might already be looking at a single, deeply intertwined machine.